Good afternoon, everyone. This is Tim with Chris Slater-Jones on the buzz. How are we doing today, Chris?
Yeah, good in you, Tim.
Awesome. Now to talk about taxes today, we're breaking down taxes. Key determinant in the finance in when it comes to personal or even if it comes to a whole country's approach, right? What segments have we got to break taxes down in for the show today?
Well, I think we can explain what tax is for people. I mean, what kind of taxes do they expect to pay here in the UK, income-wise? And then also, what do people do, especially those with a lot of money, and how they work within the tax system and what benefits there are for everyone to take hold of, because there's some real tax efficiencies and savings to be had, which increases your wealth, right? I mean, at the end of the day. So yeah, a little bit of knowledge is good.
So we're going to be basically breaking down what taxes are and how they are beneficial for a country or its community, and then also maybe a bit on how to manage paying your taxes as well.
Yeah, reduce your tax bill, right? So it's everyone wants to know.
Absolutely. That's a key here. So you're tuned in on Relaks Radio. This is Chris here. We have Chris Slater-Jones. He's been in finance. He's been consulting. He's a financial advisor, and he's been consulting for over 2 decades now. Make sure you're tuned in. Make sure you share this video with your friends that are keen on understanding more about how to handle their finances. Or even if it's you, just stay tuned in. You can call us up on 07852 473 473. You can also comment on this video. So we'll see your questions, and then we'll actually get them answered with Chris. So stay tuned right here on the buzz. We'll be right back with you after a couple of videos of who we are at Relaks Radio.
Again, but now, if you say to a child, if I went up to a child and said, "You've had one to forget," God, there'd be an inquest. Me, why did you reject my son? Well, I haven't rejected your son.
I want to talk about, how the generation gap, how much it's changed, especially when you check the youth nowadays in comparison, to people back in the day.
I'd say when I was younger, it was more disciplined. Not now.
In comparison to now.
Not at all. Not now. The way things are nowadays, the younger generation, you seem that they can't accept the word no. If that makes sense.
They can't accept rejection, essentially, is all you're trying to say.
Yeah, they can't accept the word no. So if you, how did I do? Or you didn't do very well, and they get upset, And when I was a youngster, my father used to say to me, because I used to be sport mad when I was very young. Well, I still am sport mad, but like participating in different sports. And if I had a bad game, for example, he might say to me, "You had one to forget." That's it.
Your dad sounds like a smart guy. I mean, yeah, that's the real fact of the matter, yeah.
He said to me, "You had one to forget. Get over it." And that was it. So I dust myself down and do it again. But now, if you say to a child, if I went up to a child and said, "You've had one to forget," God, there'd be an inquest. Me, why did you reject my son? Well, I haven't rejected your son. Or daughter. I've just told them that they need to buck their ideas up.
That's the truth right there. I mean, if you think about it, if you check the generations, like right now in the US as well, I've seen a lot of these things as well. In the UK, you get medals for participation. But what's the point? What are you trying to? Yeah, what's the point? Either you win or you lose. People are so afraid to put that whole notion of losing. When it comes to right now, the generation gap is just crazy. How much a lot has changed. Social media has taken control of our lives, and we don't even realize it anymore. We're crippled because of it.
That's absolutely right, Nick. Because, as you said, nowadays it seems that you get rewarded for failure. For the life of me, Nick, I can't get my head around that. Perhaps I'm just getting old and morbid, I don't know. I just can't get my head around how you could be rewarded for failure.
That's right. That's Nick and Kevin on Thursday evenings. So if you want to hear, Real Talk, that's the Real Talk show. If you want to tune into that, make sure you're tuned in on Thursdays, 3 to 6 p.m. Now coming back to our show, we were talking about breaking down what taxes are, how taxes benefit an economy, people, and how you can manage your personal taxes if it is maybe you as an individual, or if it comes to your business. So, Chris, we can go right into it.
Yeah, thanks. Let's start simply, right? We start with the taxes that everyone knows, so which is generally income tax that people pay or their employer pays on their salary, and you see that on your kind of pay slip. There's 3 bands here in the UK. You get, the standard band, the higher rate, and the upper rate, which gives you a tax rate of up to 45%. So it starts at 20, goes to 40, goes to 45% of your pay. We discussed before saying, how do rich people get rich? And they manage that. They don't pay themselves through what's known as the pay-as-you-earn system, because it's a very structured system and there's not much you can do, right? So if you earn up to £50,000 a year, you're going to pay 20% tax on those monies. There is a personal allowance for tax, which most people make use of, which currently is £12,750. Basically, what that means is you can earn that amount of money every year without paying tax on it. Anything above that, up to £50,000 or just above, you pay 20% tax on that. And then anything above £50,000 up to £150,000, you pay 40% tax on that. And then anything above that, you pay 45% tax on that. So it's quite a scripted system. There's no wiggle room. If you earn that amount through your employer, you pay that tax. You can reduce that tax bill through your employer. The only real way to do it is to contribute to a pension. So you can do what's called salary sacrifice, meaning you reduce your salary and that amount you reduce by goes into your pension. It's a good way to do it if you can afford it. So you've got the extra income, because that also reduces another tax that we all pay, which is national insurance here in the UK. So, national insurance is paid by all employed people, as well as people who own their own companies. But as a self-employed person, it's a voluntary tax. We don't have to pay the national insurance. But as an employed person, we pay national insurance. So if you contribute to your pension via what's known as salary sacrifice, you reduce your income tax bill and you reduce your national insurance tax bill. So it's always worthwhile getting a financial advisor to work that out in the first instance. So that's
now,
number one.
To when you started, you said that there were 2 tax brackets. What was that term that you used there?
So you got various tax brackets, right? So the first one is known as the personal allowance for income, which is £12,570. That's effectively the 0 tax bracket, so you can earn up to that amount and pay no tax. And then anything over that, up to £50,000 or £50,250, you're in the 20% tax bracket, so you pay 20% on those monies. And anything above that, up to £150,000 is 40%, and anything above £150,000 is 45%. So those are your personal tax. There are other tax allowances, savings tax allowances and things like that, which people can make use of, but that starts to get a little complicated and you need to work it out per individual. It depends where you are on your income tax.
Right.
So income tax, you got to pay it, right? Whether you own your own company or you are in your own personal capacity. So as an example, you own your own company instead of working for someone, right? So you can structure your tax this way. You pay yourself a salary of, let's say, £50,000 a year, and that comes off as a company expense, and you pay effectively 20%. It's a bit less because you take the personal allowance into account, but you pay 20% on that money. Then your company pays tax on its profits after expenses. So a company has a tax rate, which is 19%, so a little bit lower. And that fluctuates. It used to be 18%, 19%. And going forward, it looks like it's going to stay at 19%, but every budget, every year, that gets confirmed, and so it may change. At the moment, it's 19%. And then people say, okay, so now I've got this company profit. How do I get that out? Well, you issue a dividend. And so now a dividend has, it's just taxed at one rate. And so you can issue as much dividend as you want. You can issue £1 million in dividend, and that rate is 20%. So I earn £1 million.
Break that down for me, Chris. When you said for the dividend that there's a 20%, what's the how do we break that down? Now, when are you talking as a company or when you're receiving dividends?
So this is where, remember a few shows back where I said, when you own your own company, you're able to structure your income in a tax efficient way, right? And this is how you do it. So there's a number of sources of income that HMRC look at. One of them is, of course, earned income, which is where you get that pay as you earn scenario, which goes into the income tax bracket. The other is dividend income, which can be from your own company or from shares that you own on the stock exchange, because they issue dividends as well. And that is seen as investment income, additional income. That's a separate tax bracket. You've also got property income and various other bits. But if you're using dividend income, you can reduce your tax bill like this. Let's say it's £1 million. And in £1 million, if you do it on a pay as you earn basis, you're going to pay, and it's slightly less than this, but around 45% in tax, right? It's around there. It's probably 40%. If you structure it through your own company and you're able to take it as dividends, you're going to pay 39% in tax. People think, wow, is that a lot? Well, it's 6% of £1 million, which is £60,000. So it's quite a decent saving. If you invested that in a pension, which is a tax efficient vehicle as well, and that grew over 20 years, that can become quite a significant sum of money. So you see how you can actually structure that income to benefit you, right? You're not getting rid of tax, you're just paying less for the same amount of money. So that comes to the dividend tax. I think what's important for people to understand is that if you're working for someone, fine. You have your tax bill and you can go talk to HR and see about pension contributions. That's fine. If you have your own company, you need to talk to your accountant and get it structured. Say to the accountant, okay, how do I structure this to limit my tax bill to what I need to pay instead of, just paying tax? And that's important, and they'll go through that. Then people come to me and they say, okay, how do I invest my money tax efficiently? So this is where we make a difference as well. So I'll have an overall view of your income tax and how your income's coming in. But I'll also have an overview of the other taxes that we're going to discuss now, which is the taxes levied on investments, which is capital gains tax, which is levied on assets. So basically, it gets quite complicated, but it is the difference between what you bought the asset for and what you sold it for. If there's a positive difference, there is a possibility that there's tax due on that. You do also have an allowance for capital gains tax, and most people don't use it, right? It's £10,000 every year, and people just let that go, because if you don't use it, you lose it. And what we do as financial planners is I'll look at your assets and I'll say, okay, you've made quite a good profit here. It's still within your allowance, so we'll sell that asset and then rebuy it back in the appropriate way to utilize that capital gains tax and what's called revalue that asset at a higher level.
Right.
So now
I think I'm going to have to stop you there for a sec. But now two things. One was, now you said where you invest in an asset, and when you sell it, given that there is a positive difference, that you have to pay a tax off that. The first question is,
Yeah,
okay,
there's a possibility.
in-
Yeah.
yeah. So the first question is, okay, where do you come across a scenario? The second question is, you said you buy it back again. So in what case would we actually, come across where where a company actually sells an asset and buys it again? So I think if you can just break this down, we'll get these questions answered right after a couple of videos. Stay tuned here on the Buzz. You're tuned in with Chris and Tim. Now, what we're doing is we're breaking down what taxes are and how you can utilize it, how you actually benefit of it. Now, this is an important topic. If you like it or not, it is important for you if you basically, you are earning or if you spend in any sense. So make sure you share this video with your friends or your family. Anyone that is, just trying to learn or increase ways in how they, fill their pockets up. So stay tuned right here on the Buzz. We're with you. Chris is with us till 1, but the Buzz is going on till 3 p.m. Stay tuned. We'll be right back. Now, there's a lot of conversation around who pays more taxes, if it is the rich or if it is the poor, right? But when you are basically going out and during a day, you go to a restaurant, you have to pay taxes there. If you buy a car, you have to pay taxes there. So why is it even a conversation that, the rich pay less taxes or the poor pay more taxes? Why is it a conversation like that?
Because it's true, the rich generally pay less tax. A rich person walks into a Tesco's or a Sainsbury's, they're not going to get a different bill than another person, right? They're still going to pay the same VAT on those goods, they're still going to pay the same thing. So that's all the same. However, the differences come in if you can pay yourself from your own company, you can structure it in a way that you pay less income tax through paying a bit of salary, paying dividends and so forth, and then also deferring income. Also, your pension payments or contributions can be different. So that increases your tax sort of gap, if that, if you want to use it that way. Where a PAYE person just gets paid salary and bonus. And now those are the most highly taxed sources of income in the UK, definitely, in the UK. We've seen it, right? If an owner of a large public traded company does something wrong, irrelevant of what that company does or how valuable that company is, the stock generally falls into a pool of nothing, right? Because in a public company where the stock is traded openly on the stock exchange, the value of that stock is driven by supply and demand, it's driven by emotion, it's driven by news, it's driven by quite a lot of variables over and above the actual accounting or total net worth of that company. I mean, we've seen it, right? If an owner of a large public traded company does something wrong, irrelevant of what that company does or how valuable that company is, the stock generally falls into a pool of nothing, right? And the company may still have value, it may still be doing quite a good thing.
And it gives them something to look at, and it makes them laugh. It makes them laugh. So that's why I do it.
Oh, and it could be a really good pickup line as well. Ladies who ask, "Hey, excuse me, so why are you wearing something so colorful?" I mean, hey, you can always have something up on your sleeve. I mean, got me thinking. You want to stand out. Why do you want to stand out though so much, especially with these kind of shirts when you're riding? There must be a purpose behind it, right?
Well, when you say a purpose, Nick, what I do, I wear the shirts. Mainly, one, because they're nice and bright, so they make me visible, especially if I'm riding on the road.
Okay. Yeah, that's very important, right? Because you want cars, yeah.
Very important. And also, like, people see me in, like, calves, and perhaps I shouldn't be saying this on here, I suppose, but in the bar afterwards.
All right.
And it gives them something to look at, and it makes them laugh. It makes them laugh, so that's why I do it.
Oh, and it could be a really good pickup line as well. Girls, ladies who ask, "Hey, excuse me, so why are you wearing something so colorful?" I mean, hey, you can always have something up on your sleeve. I mean, you look like a guy who would do.
You know me too well. You know me too well, Nick.
We left off at when it comes to purchasing assets and then selling assets again. Given that you have a positive return on it, you have a positive difference on it, you have to pay a tax on it. And also coming back to, buying the asset, Chris is basically going to answer these questions for us. So if you also have any other questions that you want to, ask Chris, make sure you comment on the video down below, or you can also call me up on 07852 473 473. You can WhatsApp us on that number as well. So coming back to the answer, Chris, we'll get back into it.
Yeah, no, look, good question. And the main scenario I find it in is that people, we look after and manage their money in the investment world, which is generally through portfolios of assets. So it's a whole lot. And then we can assess those and say, okay, you've made a profit. And just to correct myself, the capital gains tax allowance is not 10,000, it's 12,300 pounds, just to make sure that's correct. And so we make sure that it's within that realm. And then what we can do is we can trade in and out of that portfolio so that we can make use of that gain. And so it revalues that person's portfolio so that each year it doesn't come, because this is what can happen, right? A person, and I'm not talking about the tax efficient investments here, this is just a general portfolio, is that a person will have that portfolio for 10 years and then sell it for whatever reason, okay, retirement, buy a new house or whatever. And they suddenly have made £100,000 on their portfolio, which is fantastic. However, they now have to pay capital gains tax. Yes, capital gains tax is 10% of the gain, but it's still, you don't need to be paying that if we do our jobs correctly, so we can save you that money. Let's say it is £100,000, so you're paying upwards of £9,700 for that, where it's not necessary. So that's what I'm talking about in a personal sense. Corporations do it as well, so they make sure that they are as tax efficient as possible, but it's not always possible. I'm not talking about immovable assets here or large assets like houses and things like that. It doesn't work on that. Yeah. This is just mainly kind of stocks and shares investment portfolios that we can actually help people with. So does that answer your question? Does that make sense?
Yeah. So it's, and again, just to break down an instance where maybe you don't have to mention your client's name, but then if you can just tell me a situation as to how someone repurchased an asset, and is it always real estate, or what other situations?
There's no real estate. We don't do this with real estate. You can't do this with houses and real estate, mate. You can only do this with stocks and shares or liquid assets. Right. So, and every year, at the end of February to kind of the beginning of March, I send out what's called a tax year-end campaign to all my clients. And what it does is, for each of them, we have a look and we say, okay, you can make use of your capital gains tax allowance. You can, and use the other allowances that I'll go into in a short while. And we repurpose their portfolio. We trade them out so that we make use of that capital gains tax allowance every single year for, probably 70% of my clients. We do that. So it's something that should be done by a financial advisor or investment advisor every year. And if they're not doing it, you're missing out. You're actually missing out on something. So yeah, right. That's important. Right. So understood. Capital gains tax is good. Yeah, sorry, carry on.
Yeah, understood.
Okay, because I know this is complicated, right? And so as I go and talk, you must just interrupt me, because I do understand. We can get carried away. So that's okay. So then you have a look at, okay, so where can I invest my money to get the most tax efficient returns, right? Because that's what you want. You don't want to have to worry about capital gains tax. You don't want to have to worry about dividend tax. You don't want to have to worry about a couple of other bits and pieces. So pensions are the first one. And the reason they are tax efficient is because you can't access them easily until the age of 55. And then when you do access them, yes, they are flexible. However, you're going to pay income tax on that at a later date, and we can reduce that bill. But pensions are the best. When you contribute to a pension, why it's so tax efficient is that if your employer contributes via the salary sacrifice, as we discussed earlier, then you get that saving on your national insurance bill as well, which is 12.8%. So that's quite a good saving. And then, of course, you pay less income tax because you're earning less. There's less money coming to you. If your employer doesn't pay it and you pay it out of monies that have already been taxed, which a lot of people do, then the government will add 20% in for you. So if you put £1,000 into your pension account, there'll be an extra 200 added in by the government. So that's already a 20% return on that money straight off the bat. So very, very good. And if you are a higher rate taxpayer or the highest rate taxpayer, then you can claim the additional monies. Of course, it's only if you've contributed in that bracket. So I'll explain that quickly. So if you're a high rate taxpayer and above, at the end of every year, you need to do a self-assessment. You have to go onto the HMRC website and submit a return. For the standard rate or lower rate taxpayers, if you're up to £50,000, you don't have to do this. And the reason the government want to do that is that they want to make sure that you're paying the right tax. And if you contribute to a pension, the government will add 20% in, which is great. However, let's say I earn £100,000 a year and I put £20,000 of that into my pension. The government added 4,000, which is the 20%. And then I can go to the government and say, okay, but I added 20, so you owe me another 4,000 because I'm a 40% tax rate payer and I get that tax relief. And they will then say, there you go, there's your £4,000.
Right.
So you can claim that back. So it's very, very, very tax efficient on that. And of course, in the pension itself, there's no taxes on the underlying investment. So it grows quicker because it's just not as many charges coming out. So that's your first port of call, put into a pension. But then some people say, well, I don't want my money to be put away for the next 30 years or all of it. I've got a portion going, that's fine, but I want to save it for a house or a car or a holiday or something like that. So your next port of call is the individual savings account, or the ISA. And you've got two types. These are tax efficient as well. You don't get like the pension, you don't get tax back on contribution, because now you've been taxed, you've got your money in your bank account, you just add it to the individual savings account, and there's no tax within the account. So you're not getting capital gains tax or anything like that. Now there's two types. You've got the cash and you've got the stocks and shares, right? The cash, I would steer away from the cash if you're saving for the medium term or for something big, because of course the cash, as we know, as we spoke about, will get degraded by inflation. There's not great returns. If you are saving for something like in 6 months or something, then the cash is the way to go. Most people do stocks and shares, and we invest that in the market in that tax wrapper. Now there's a limit, of course. You can only do 20,000 a year per household, and then there's also a child limit.
Right. And yeah, so when you talk about now coming into how the government, maybe if we can break down how we are getting taxed and where the money goes, how it is broken up in terms of budgets on an annual basis, and then where the money goes into, if it is education, if it is into healthcare, security, these things. What's this process, Chris?
So and this is an arguable point. If we go back to the money versus currency chat, right? The only reason we get charged income tax for the large part is for governments to be able to pay the interest on the loans on the money that they've borrowed, because they're all in deficit, right? So that's where a large part of the tax goes to. But of course, our tax also goes to things we can see around us, mostly in the UK, to military budgets. However, it also goes to roads, goes to councils, it goes to, and they bid for it. They submit their budgets every year, and they lobby for it, and they try and get as much money out of the government for various social projects and benefits, everything. So all the road work, schools in this country, the NHS also gets funded, and this is a combination between income tax and national insurance. Because remember, the national insurance also, in large part, provides the old age pension, the UK old age pension, to people, which is currently quite large relative to the base paying into it, because they don't have this pool of money that's invested. It's as it comes in, they pay it out. So we've had the baby boomers, which are retiring, and they're busy going through that now. So they're a large segment of the population at the moment. So it's under a bit of strain. But paying taxes for government is important. It's an important part of their budget process.
Right.
You know.
And
yeah, sorry.
And in terms of you were going you were talking, Chris. I think if we can just understand the next segment that you're going to break down.
Going forward. No, well, I was just going to mention how they collect taxes. I mean, governments collect taxes here on a trust-based system, HMRC, as is a lot of countries around the world. So they trust you to tell them what taxes you should be paying, which can get you into hot water, right? Especially if you're trying to, sort your taxes out in a way that is as efficient as possible, but you're not an accountant and you don't know the tax system as well as you should. So, I personally have an accountant who helps me with it because it's important. You don't want to slip up on taxes, and you don't want to slip up on filing dates and all these kind of things because, the government will come down, and then you've got fines and all sorts of issues, and you don't need that. So even if it's what we call a null rate return, i.e. you don't need any tax paid, you still pay them. So that's important. Right. I think what's good for people to understand, what I wanted to do on the back end of this, which I didn't mention in the beginning of the program, is to talk about estate duty and estate taxes, because it's an area that very few people touch on because it is quite complicated, and most people think, it doesn't apply to me. And a lot of people think, well, even if it applies to me, I don't care because I'm dead and my beneficiaries get the money anyway. But I'm of the view to say, okay, hang on. Here's a tax that is totally voluntary. And if you do a little bit of planning, you don't have to pay it. We can actually get rid of the estate duty tax in your estate if it applies to you, just with a little bit of forward planning. And we can do it intergenerationally, meaning not only for your children, but for their children and their children and their children. Because what people tend to forget is that, okay, I plan now and my kids will get it in a tax efficient way. That's brilliant. But what happens when your kids pass on? Suddenly they haven't planned and now that money gets taxed again, right? So we can do a few things like that. And it doesn't necessarily have to be complicated. So stop me any time, because, we'll explain it in greater detail. But, we're going to mention the word. I mean, we use trusts, so what is a trust? A trust is just a separate entity that holds your assets, that allow your assets to be separated from you. So, effectively, you shouldn't have any control. You shouldn't be, and that gets it out of your estate in certain instances to allow for a tax efficient transition of monies to the next generation. What you want to do first, carry on.
We can maybe get into how we coordinate trusts in our favor, or just to stay away from fines, to make sure our accounting is all organized. And
it is, and you need to get it organized. You're absolutely right.
Yeah. And to we can maybe, obviously, since we have you and your experience, you sharing your experience and your knowledge on what you've learned over the years, we basically have that broken down as well. We'll add it to a segment before, right after a quick break, and we'll actually just run in the lines of whatever else that I think what I think we can talk about is also very briefly what else we take for granted that what else we maybe just don't notice our tax money going into, that we can use on a daily basis, that if it is people working in the government, if it is services that we basically what the services that we basically take for granted, or might not take notice of. So we'll break these things down as well, and then go into the last two segments of the show. This is Chris Slater-Jones from CS Jones, on the show on the first hour with us on the buzz for the day. He's with us on all Thursdays for the first hour from 12 to 1 p.m. Stay tuned right here on Relaks Radio. If you don't have access to your mobile, to a desktop, or you're watching the show on YouTube or Facebook all the time, you can always download our app. Our app is free. It's available on the App Store and Google Play. Make sure you're tuned in on Relaks Radio. That's RELAKS Radio. And call us up, comment on this video. Make sure you're engaging with us and ask all the questions you have with regards to tax from Chris. So stay tuned right here. We'll be right back after a couple of videos. Good afternoon.
Again. But now, if you say to a child, if I went up to a child and said, "You've had one to forget," God, there'd be an inquest. Me, why did you reject my son? Oh, I haven't rejected your son.
I want to talk about, how the generation gap, how much has changed, especially when you check the youth nowadays in comparison, to people back in the day.
I'd say when I was younger, it was more disciplined. Not now.
In comparison to now.
Not at all. Not now. The way things are nowadays, the younger generation, you seem that they can't accept the word no. If that makes sense. They can't
accept rejection, essentially, is what you're trying to say.
Yeah, they can't accept the word no. So if you, how did I do? Or you didn't do very well. And they get upset, And when I was a youngster, my father used to say to me, because I used to be sport mad when I was very young. Well, I still am sport mad, but like participating in different sports. And if I had a bad game, for example, he might say to me, "You had one to forget." That's it.
Your dad sounds like a smart guy. I mean, yeah, that's the real fact of the matter, yeah.
He'd say to me, "You had one to forget. Get over it." And that was it. So I dust myself down and do it again. But now, if you say to a child, if I went up to a child and said, "You've had one to forget," God, there'd be an inquest. Me, why did you reject my son? Oh, I haven't rejected your son. Or daughter. I've just told them that they need to buck their ideas up.
That's the truth right there. I mean, if you think about it, if you check the generations, like right now in the US as well, I've seen a lot of these things as well. In the UK, you get medals for participation. But what's the point? What are you trying to? Yeah, what's the point? Either you win or you lose. People are so afraid to put that whole notion of losing. When it comes to right now, the generation gap is just crazy. How much a lot has changed. Social media has taken control of our lives, and we don't even realize it anymore. We're crippled because of it.
That's absolutely right, Nick. Because, as you said, nowadays it seems that you get rewarded for failure. For the life of me, Nick, I can't get my head around that. Perhaps I'm just getting old and morbid. I don't know. I just can't get my head around how you could be rewarded for failure.
There's a lot of conversation around who pays more taxes, if it is the rich or if it is the poor, right? But when you are basically going out and during a day, you go to a restaurant, you have to pay taxes there. If you buy a car, you have to pay taxes there. So why is it even a conversation that the rich pay less taxes or the poor pay more taxes? Why is it a conversation like that?
Because it's true that the rich generally pay less tax. A rich person walks into a Tesco's or a Sainsbury's, they're not going to get a different bill than another person, right? They're still going to pay the same VAT on those goods. They're still going to pay the same thing. So that's all the same. However, the differences come in if you can pay yourself from your own company, you can structure it in a way that you pay less income tax through paying a bit of salary, paying dividends, and so forth, and then also deferring income. Also, your pension payments or contributions can be different. So that increases your tax sort of gap, if you want to use it that way. Where a PAYE person just gets paid salary and bonus. And now those are the most highly taxed sources of income in the UK, definitely, in the UK. We've seen it, right? If an owner of a large public traded company does something wrong, irrelevant of what that company does or how valuable that company is, the stock generally falls into a pool of nothing, right? Because in a public company where the stock is traded openly on the stock exchange, the value of that stock is driven by supply and demand, it's driven by emotion, it's driven by news, it's driven by quite a lot of variables over and above the actual accounting or total net worth of that company. I mean, we've seen it, right? If an owner of a large public traded company does something wrong, irrelevant of what that company does or how valuable that company is, the stock generally falls into a pool of nothing, right? And the company may still have value, it may still be doing quite a good things.
Mount Everest. That is one of that's in my bucket list. You're laughing, but that is the facts right there. I'd love to do that. That is something I'm looking forward to do, hopefully.
Climb Everest.
Mount Everest. I mean, okay, not the very tip of Mount Everest, maybe the base camp at least.
You're talking about mental health. Well, if you went out and got some exercise in the fresh air, that will improve your mental health. It will make you feel better.
That's true. That is true. I wholeheartedly agree. But then for some people, it's how do you find the motivation to, especially when it comes to riding a bicycle, to do it again and again and again and again? It's a cycle that you have to be used to. How do you do it? What makes you wake up in the morning and decide, hey, I'm going to pick my bike up today. I'm going to cycle. What makes you want to do that?
What makes me want to do that?
Yeah. What do you like? What could you give listeners, like people listening in right now? What kind of tip could you give them?
Well, the first tip I would give them, if you haven't tried it before, try it. It can open up new horizons. It will make you fitter. It will definitely make you fitter. Cycling is one of the best forms of aerobic exercise you can do.
It sounds like, if you think about it, yeah, it sounds like great fun. Because what essentially you're trying to say is also at the same time, when if you look at it from this perspective, with regards to mental health, especially when you look at it with mental health, this is another way to fight it. I feel like you go outside, you meet more people, you interact with, socially, you will interact with more people, and you're keeping fit, you're making connections, you're breathing in the good and exhaling the bad. I feel like that's a great thing right there.
Absolutely. Yeah, you got a better way with words than I have, I'll tell you. But you're quite right. What you say there. You're quite right.
I've been doing this for quite some time. Hey, you'll get the hang of it.
I've been doing it for about 10 minutes now, so yeah.
That I can never really understand people staying in one room the whole day when you can have the world to see. I am a traveler. I travel. I love traveling. Traveling is just one of the things I do. And yeah, on top of my bucket list was, to one time, hopefully when I get there, go to Nepal and climb Mount Everest. That is one of that's in my bucket list. You're laughing, but that is the facts right there. I'd love to do that. That is something I'm looking forward to do, hopefully.
Climb Everest.
Mount Everest. Okay, not the very tip of Mount Everest, maybe the base camp at least.
Base camp, yeah.
At least.
We should be able to cycle there.
Oh.
That's right. This is Relax Radio. If you are not tuned in on our website, make sure you download our app. You can basically download our app and you only listen to us instead of have us on your screen all the time. So wherever you are, if you're at office, if you're at home, you can basically tune in and have us in your ears. Getting that information, staying updated midday, getting basically giving you conversation starters, or basically, if you want to talk to your peers, if you want to talk to your customers, your clients, this is the midday show. We're on the buzz with Chris Slater-Jones. Stay tuned right here till 3 p.m. Chris, we were talking about how the taxes are broken down, and then we were talking about how it's it rotates through the government and then it comes back to us. What process is best to assume, or what actually happens with the money?
Well, I mean, you see all the jobs, right? You from here in the UK, or post offices, or a postal system. The garbage men, two really important jobs, right? That we possibly take for granted.
Absolutely.
That when they don't work, you notice. It's
absolutely. I mean, I'd say, especially during the first two waves of the pandemic, you actually start realizing how much you take for granted. Although you might just brush, turn a cold shoulder on these guys, you'll actually realize how dependent you are on these guys.
Well, exactly, and it's also the street sweepers and all of those guys that do that job. So your taxes pay them basically. So which is good. It doesn't mean they are your employee or you can boss them around. They provide a service, and the government is kind enough to pay them on our behalf using our money, of course, but that's okay. The other ones, which you may find hidden, internet access. I mean, there's a lot of cabling that's owned by governments. There's a lot of electricity infrastructure and things like that are hidden from public view, and we'll never see it. However, there's a cost to maintain it and a cost to keep it going. While there is privatization in that area, it's still subsidized by the government. And of course, we're now going back to the nationalization of the railway. So your taxes will go toward that again. How they will change, we don't know, but that'll be another key kind of element in our day-to-day life that we need to make sure we look after. And then again, you also have your council offices. So there's a lot of work that's done in the background, from organizing, the garbage men and various people like that, all the way through to, putting up flower baskets along the high street in spring, or Christmas lights, or things like, and they're small things, but they still cost money. They still need someone to go and do it. And it just makes life a little easier. So there's a lot that the taxes do. And to be fair, here in the UK, because we won't compare it to South Africa, which isn't as efficient as the UK, is the councils actually do quite a lot on a small budget. The other important benefit that we get from our taxes, of course, and I'm leaving them to last, but is the firefighting force. So that's quite critical, and of course the NHS. So you don't. I think pre-COVID, pre-pandemic, most of us, and I'm not counting myself here because I love the NHS.
Yeah.
Because I come from a country where we don't have that equivalent. People took it for granted, right? And then
absolutely,
yeah, and so now you see, yes, look, you may have to wait sometimes, and you may not feel it's as service driven as it possibly could be, but come on, it's pretty special, and what's being done. And again, I think they're on pretty tight budgets, and there's a highly skilled workforce in there doing a lot. So your taxes pay for a lot of very skilled people, and I'm including garbage men in this because, running up and down at the back of a truck and pulling things along is a different set of skills to a neurosurgeon going into your head. But it pays for a lot of them to do a lot of jobs that we can't do, wouldn't be able to do, and most frankly, most of us can't live without. So, yeah, it's important. It's important. So, look, I'm not advocating not to pay tax. What I am advocating is that you pay the right amount of tax. So, and knowing the right amount to pay can be tricky sometimes, because most people, in my experience, tend to overpay a little bit, where we could reduce it legitimately a little bit and then use that money to better those people's lives, which just makes society better anyway. Because if you've got more savings, you're less reliant on the state, right? If you've got more pensions, you're less reliant on old age pension, and all these things have a knock-on effect, especially across generations. So that's the thinking between, and it's one of our most it's a tangible benefit of financial planning. A lot of it isn't tangible what we do. It's just kind of, we may get a return here, or you've got life cover here, or you've got a mortgage. But tax benefits are a real tangible effect of financial planning, because you feel it. You can see extra money in your bank account, or you can see extra money in your investment account. So it's one of the most satisfying things we can do for people.
That's right.
Yeah. It makes it.
We're just coming into the end of the show, but we've also we've broken down quite a bit. We broke down what taxes are, how taxes are charged on you regardless of what way you're earning your income, if it is through investments, through your cash flow, through your salaries, and then also how it comes back to you in terms of a service. Now, this is the buzz. On Thursdays, we got Chris Slater-Jones. He's been in the financial advising industry for over 2 decades. And, if you want to basically ask him anything with regards to investments, savings, next week is the place. Next week, you need to be on the show as well. Next week, it's from Thursday, 12 to 1 p.m. Chris, thanks for joining in today.
Thanks, Tim. Always a pleasure. I'm just looking what we're doing next week when
We're talking about investments and savings, and why we're not getting rich. As it. We got pensions the week after, and then afterwards and 2 weeks from now is estate planning.
That's right. Yeah, investments and savings next week, which just leads on from this, right?
Absolutely, yeah. I'm excited for the next one as well. I mean, I'm honestly not the biggest, the biggest fan of accounting or doing accounts, but I think I've told you this before, but I understand the importance. I've just started, putting a portion of my salary into stocks, into other forms of investments, and reading balance sheets. I'm obviously putting myself around a couple of friends that are in broking and also advising. So it's a bit of a challenge, but I know it'll pay off in the long run.
The main thing is to start, right? And it doesn't have to be complicated. You don't have to do accounting or budgets or anything. Or like you say, all you have to do is say, look, let's put a little bit away. And then once you start that, ask, how can I do it a little bit more efficiently or a little bit better? And so you iterate through the process.
Absolutely. Appreciate you being on the show as always, Chris. Looking forward to next week.
Good man. Have a good one.
Thanks, Chris. I'll catch you next week. Thanks everyone for tuning in. Make sure you keep your questions ready if you are tuning into the show next week. We're talking about investments and savings with Chris. Make sure you don't miss the show. That's Thursday, 12 to 1 p.m. Good afternoon. You're tuned in on Relaks Radio.